So market continues in one direction, which is down. And when you look at the market down 1.3, 1.4%, you're kind of describing what's going on or what might have gone in for the market to be down so much. But I think we've also been consistently making the point over the last 2 weeks that this is demonetization, especially, is really hurting business activity. I mean, across the board. And I think that is what is going on to a very large extent. I mean, levels 8,000, well, round numbers are always taken as psychologically important numbers, and I understand that. But I mean, there is nothing really sacrosanct about 8,000 or 7,900 or 7,800 for that matter. Technically, I mean, there are points where supply-demand meets or instances where bounce backs, etc., have happened, retracements. I understand that logic. But I think, really speaking, I mean, I think what you're seeing on the screen is what's going on out there on the ground as far as business activity is concerned. Add to that a couple of points, and this is global. I don't think we should take our eyes off global cues as well. And I think we've discussed this every time on the top of 11. The dollar continues to move up. The US rates continue to move up as well. I mean, so think about it like this. As US rates go higher and Indian bond yields go lower, I mean, the bond yield was what, 6.4, 6.45%. The US 10-year is about what, 2.35 or so. The relative attractiveness of a market like India actually goes lower. I mean, one can argue and say that bond yields fall even further, right? You account for what, 5-6% hedging cost. I mean, then you're not looking at really attractive kind of returns, right? So that is an important point. I mean, rates in US rising and dollar rising, no brainer. I mean, it is negative for emerging markets in general. It's been in history as well. The other big trend, which doesn't get talked about, but I think it's an important play, we get these numbers from EPFR every week, right? They collate what's happening in the world of funds across the globe. Money is leaving actively managed funds at an alarming rate. It's going into ETFs. What the implications of that is going to be, I think one will have to wait and see. But ETFs are passive money. Markets are going down, ETF money goes out. Markets are going up, money comes in. I mean, that's how typically ETF behavior works. Active money, markets go down, a human being would see that as a great buying opportunity, right? I mean, very crude, basic kind of difference between active money and passive money. So that is the second trend. There is political risk in Europe again. I mean, so bond yields in Europe have been sort of rising. Italian bond prices fell off a cliff actually last week, Thursday and Friday. There is a constitutional vote coming up in Italy, which may actually result in the ouster of its prime minister. What that may lead to, what is being talked about is serious doubts about Italy actually remaining in the Eurozone. While we may talk about central banks and ECB, for example, coming in and protecting the euro, there is precious little that the ECB or any other central bank can do as far as political risk is concerned. So I think that is the other important thing. And as I said, I began by saying the local sentiment, local business activity, etc., remains very, very muted. We've been speaking with companies across the spectrum, and I think you're seeing varying degrees of fall in business activity, which one is hearing about. What one will have to see is how far this slowdown really lasts, and there people kind of differ very widely. Some say, well, this really hurts the economy for the next, 6, 12, 18 months. There are others who say, well, this is temporary, October to December, maybe Jan to March, that's the fourth quarter, and after that, we're going to be just fine. But I think that we'd only be wiser in hindsight.
Yes, absolutely. And when you were talking about emerging markets correcting, the likes of Brazil is down around 7% on a month-to-date basis. We have Mexico as well. So there's a lot happening globally, which is
I would say one thing. Brazil, Mexico, Russia, these are, I don't think we should really compare ourselves with these countries. I mean, these specific countries have so much idiosyncratic risk. I mean, there is Mexico with regards to Trump. There's huge political upheaval in Brazil. Russia, for example, right? I mean, so I think for us, you want to compare us, India to say something like an Indonesia, I mean, where fundamentals are improving. Yeah, so I think those are better kind of comparisons to kind of make rather than the peso or the equity markets there.
Yes, absolutely. But important and